Take my glass to see it better. And now, as I said, the topic today is this perception in 2024 among emerging market economies. And here we are. Let's start with China, the biggest emerging market economy, and maybe the second largest economy today, but in next couple of years, it will be the first top 5 economy in the world. And please try to look at what's happening in China, sector earning and valuation. And here we have an MSCI China earning growth estimate, meaning that in which sector China economy can get an earning per growth, EPS, earning per share growth. And this is year-over-year change here on the y-axis. And here x-axis, as you see, we have different sectors. And in the bottom, we have definition. The black is 2024 and the green is 2025. 2024 estimate 3 months ago is gray line, and 2025 estimate 3 months ago is the dark green one. Please look at this one. Earning per share is better in real estate sector. Why? Because during the last 2 years, the real estate sector is crashing in China. And now, especially on these days, Chinese economy giving lots of incentives to the real estate sector to trigger the growth in those economies. For that reason, the earning per share will be the top tier in the real estate sector. And the worst one, the worst case is for the technology sector. It is crashing rather than the growing. So if we take an average, the worst sectors I like financials, industrials, or utilities, but the best sectors are like the consumer discretionary, consumer staples, and etc. And these are the sector rates. As you see, the financials are approximately 18%, and the lowest one is around utilities and the real estate around 2%. And now we will try to understand, this is earning per share, the EPS growth. And now we will try to understand what's happening in China, price to earning ratio, the PE ratio, in last 2 workshop and the living session, we tried to understand what is PE ratio. PE ratio is price earning ratio. And if price earning ratio is higher than its, let's say, 10-year or 20 years average, that sector, that company, or that economy is expensive. And as you see here, please look at this one. This blue line showing the average, and the green one is showing the latest observation. So if the green is lower than the average, that one is cheaper. So let's take a look at it. In China, please look at this picture. In China, almost all sector is cheap. Almost all. Financial, real estate, energy, industrial, utilities, materials, consumer discretionary, consumer staple, communication services, even technology and healthcare. All is cheaper, not expensive, because their average is higher than their latest observation. Okay, you can decide while taking a position in those type of sectors, you can try in this way. How I can decide which one is cheaper, which one is expensive, or what is the exact time and correct time to get a position in that sector or in that economy. By just looking at the price earning ratio, you can take an average of the, let's say, 10, 15, or 20 years average, and you can look at what is the latest observation. If it is lower than the average, then it is cheaper. To increase my efficiency, I will close my cam, okay, because my internet connection is going down. For that reason, I think everybody can hear me. And now, the same picture for the India, sector earning and valuation again. And now, the Indian sector here, as you see, the sector earning and valuation, and again, the MSCI, the Morgan Stanley Index, India earning per growth. This is again EPS growth. Here in the x-axis, the factors, and here in the y-axis, we have year-over-year percentage change in Chinese economy. And now, it is Indian case. And now, as you see here on the right-hand side, we have another screen. It is the price-earning ratio. If I try to understand what is happening in this picture, we can directly understand that. On the left-hand side, please look at and please do the same logic here. What is the logic? Our logic is this. If the earning per share is best, I can take a position in that sector or in that economy. What is the best? The communication services in India. Because Indian technology and communication services are really, really good, especially in software sector. But what is the lowest one? Please look at this side. This side showing that utilities, technology, and consumer staples are crashing so low. It is like, let's say, lower than the 10%. This is earning per share, by the way. And if I look at the price earning performance in those sectors again, the logic is same. If the latest observation is lower than the 15 years average, that is cheaper, or vice versa. Meaning, if the latest observation is higher than the 15 years average in this side, then we can say this sector is expensive in that economy. And now, if I take a look at this one, please look at this picture and try to understand which one is expensive and which one is cheaper. If latest is less than the 15 years average, then it is cheaper. Please look at the picture. Only here we have the financials. It is almost same with 15 years average. In other sectors like energy, utilities, materials, or let's say technology or consumer staple, average is here, and latest observations are here, like the green dot. So in India, only the financials is cheaper, but in China, almost all sectors are cheap because it is either lower than their 15-year average, is almost same their 15-year average. So here, if the attendance is, let's say you have $1 million and you want to take a position in China or India, and then you want to decide in which sector you will take a position. In this case, you will directly do this. First, you will decide which one is better. It is directly the Indian economy. Then I will decide if the Indian economy, which one is cheaper. It is Chinese economy. It is almost all sector is cheaper. But in China, which one is better? Then I will choose which is so far away from their 15 years average. Which one? For instance, let's say consumer staple. Average is here and the latest observation is here. Or let's say healthcare. Average is here and the latest observation here. There's a gap, and this gap will be filled. For instance, for the real estate sector in China, the average and the latest observation almost there. So we cannot directly say that this is cheaper or expensive. We can only say that in this sector, I can take a position like, how can I say, only if this average will be higher than those 15 years moving average, let's say. Because especially in last 5 years, or especially in last maybe 3 years, the average can be diverged from their 10 years average again. So to understand this concept better, I can take a moving average concept. In this style, you can understand better what's happening in Chinese economy and Chinese sector. Then, as you see here in India, I can understand directly that this is my Japan economy. Now it is the turn of the Japan. I included the Japan because normally today's topic is covering the economies in emerging markets. But the Japan is here another case because all developed market economies have a contractionary monetary policy as of today. But the China is trying to increase their monetary policy expansion, and they are getting benefit from those sides. So please try to look at now the picture in Chinese economy. And here, as you see, I have different sectors in China. Those are like, as you see, utilities, energy, real estate, industrial, consumer discretionary, financial, and similar to those Indian and Chinese economy. But as you see here, the 2024, 2025, and their estimates 3 months ago. And earning per share in worst case in utilities, but it is best in Japan in financial. Why? Please try to understand why the Japan financial estimate is better in this case, but not in that case. Because now in financial sector, because the Chinese economy and Japan economy making an expansionary monetary and fiscal policy and rate cut position, while the Fed, ECB, other central banks increasing the interest rate, but the Japan and China decreasing the interest rate. So the financial sector, banking sector benefiting from this rate cut. If the interest rate is decreasing in those economy, then I can easily understand that financial sector in China and in Japan will benefit from those positions. And now, MSCI Japan price to book ratio. Now, I will do the same like I did it in China and India. Here in earning per share and here price to book ratio. And price to book ratio, please look at here. Normally here, we look at price to earning ratio. Here again in India, we look at the price earning ratio. But now it is price to book ratio. What we mean by price to book ratio? Price to book is, I'm trying to understand what is the real value of the company and what is the market value of the company. If the market value is higher than the real value, it is expensive. So if the price to book ratio is higher than its average, it means that it is expensive. Please look at this picture. And please look at the bar, the blue bar showing the average and latest observation in green. What does it mean? Here in, let's say, technology, it is absolutely higher than its average. The average is around 1.5, and today it is 3, meaning that the technology sector is expensive 1.5 times its average. So if you have a money, if you want to take a position, if you want to buy some stock exchange in Japan economy, it will be the last case for you to take a position in the technology sector. But if you take this position in utilities or in the real sector or real estate sector, this means that this gap between average and latest observation will be filled. So now if we turn on the page and we understand what is happening in China, India, and Japan, then we can easily say that China is the cheapest one among these. And if you take a position in China, you can take position in any sector, but if you take position in consumer staple, technology, and healthcare, your earning will be the highest. But in India, almost every sector is expensive, so please try to not take a position in India. And in Japan, some sectors are expensive and some are cheaper. And if you want to choose those ones, the cheaper one is energy, utilities, real estate, consumer staples, and others are all expensive according to their price to book ratio and price to earning ratio. And now we will try to understand what's happening in the Europe and other developed market economies and their understanding, their behavioral dynamics in the valuation and stock exchange. So if we take a position in Europe, please try to understand here the average discount premium since 1997. And this is black one. And this current discount, and this is premium, and this is today. Please look at the sectors here. These are the sectors in IT, healthcare, industrials, consumer staple, materials, utilities, communication services, energy, financial and consumer discretionary. So, if you look at the current discount and if you look at the average discount, approximately last 30 years, today, almost all sectors is discounted, except the industrials. They're almost same their average. But other sectors are discounted. What does this mean? They are really cheaper for you. If you want to take a position in Europe, except industrial sector, you can take a position in any type of this sector. They will give a really good premium and earning at the end of the year and the session in 2024, if you have a possibility to take a position in these sectors. And now, if I take a look at the buyback and dividend yield performance in the euro, please look at this. You know, dividend is when the company write a net earning at the end of the year. As a shareholder, you will get a proportion from this sector. So this is your dividend yield. And this is net buyback yield, this green one. And here, as you see, dividend yield is almost around 3.5% in Europe, and in UK in 4%. And dividend yield is lowest in the United States. Emerging market is almost 3% in dividend yield as well. But net buyback position in emerging market is negative. What does this mean? Buyback is this. If a company see that the real value, let's say, for that company is $120 in stock exchange. But because of a speculation or manipulation in stock exchange, the price of that company from 120 decreased to $80. Then the company declaring a buyback program. What does this mean? Company is saying that according to my valuation and calculation, my company fair value is around 150, but today it is $80. So I will buy back my stock and shareholding from the market. And here, as you see, even in Europe, even in UK, and even in United States, all companies making a buyback. But in emerging market, it is not. What does this mean? Because emerging market during the COVID-19 crisis, even during the COVID-19 crisis, they benefit from lots of opportunity. And during this expansionary multiple society, during those type of valuation and during those type of expansion, they benefit from these opportunities. So today, they are really, really expensive. So none of the company in emerging market declaring any type of buyback program. And now, the risk perception. Please remember the title today. This is risk perception. And the biggest risk today in emerging market is debt. Emerging market debt today is one of the biggest problems for the rest of the world as well, because those debts who is coming from for the emerging market is coming from the developed market. So if there is a default emerging market, it will be a problem for developed market economies as well, because the money in emerging market is coming from developed market. So please try to understand this chart. Here, as you see, I have emerging market debt spreads to the United States treasuries and returns. And the definition here is 12-month forward total return. Spread is in basis point, meaning that 1 over 10,000. This is basis point. Here, this is percentage. And here, you see the current spread. Normally, the current spread is around 300 and 350. And sometimes, as you see, it can diverge from in lots of economies, even 900 basis points. These economies are risky economies because their spread between the US Treasury and emerging market debt is really, really high, approximately 900 basis points. and the average is around here, 350. Then total return will be around 10%. As these economies are really volatile and risky, their spread is really high, but their total return also higher than the average 10%. It is approximately 40%. And now, here what we have, emerging market real and nominal yields. What we mean by real and nominal yields? I'm sure lots of attendances here who attend our session regularly and try to understand what's happening in financial market and emerging market economies or developed market economies. They will easily understand the concept about the nominal and real. If we speak about real, it means that I'm adjusting the numbers according to the price changes. So if I have a nominal yields here, and if I have a real yields here, the difference between these are inflation. Okay, nominal and real yield. Please look at this explanation. The black one is the nominal yield, and the blue dot is the real yield. Here, as you see, the nominal yield is almost same with the real yield in China. What does this mean? This means that the inflation in China is almost equal. There is no difference between real and nominal. But for instance, in Poland, nominal is here and real is here. What does this mean? If nominal is approximately 5-6% and real is 0, meaning that there is 6% inflation in Poland. Okay, or let's say in Mexico, if the nominal yield is around 10%, and if the real yield is 5%, this means that we have 5% inflation in Mexico. So lots of high yield bonds, hedge funds, those type of funds and stocks taking position, especially in economies who have an efficient monetary policy and try to decrease their inflation rate for the long term. What we mean by for the long term? If you have an economy today, and if it is a high in inflation today, then they will start an monetary and fiscal policy to deal with the inflation and let's say debt in the financial market. Then if the investor believe that the inflation in the long run will decrease, they will take a position. Because if inflation going higher, you will lose your money because of the price hike. So, as you see here, in emerging market, the best position is almost in China, in Thailand, in India, because inflation is really low in this economy. And now, as you see here, please try to understand this side. Please take a picture for 1 second. Please try to understand what is in this picture, because I'm making explanation, but it is also important for you to understand what these type of charts and graphs showing for the rest of the world and for the emerging market economies and their monetary policy implementation. What does this mean? This policy rate cycle and market performance showing us to that. On the left-hand side, asset class returns following the end of rate hikes. Please look at this one. It is saying if there is a rate hike, meaning that if the interest rate is increasing, what is happening to asset classes? If there is an increase in interest rate, what will happen to these type of asset classes? Please look at the equities, fixed income, and others. These are, let's say, hybrid bonds, mixed portfolio, those type of things. And here, as you see, the equities are the highest one in the return if there's a rate hike. Then if it is in fixed income, the average return is around 10%. Then if it is others, it is a mixed strategy. It is a volatile strategy. In some, let's say, if there is cash, gold, dollar, and 60-40 portfolio, what does this mean? If you have 60% of the stocks and 40% of bonds, meaning that 60% is risky and 40% is riskless. Here, as you see, please look at the fixed income side, this side. I have US 10-year Treasury, 10%, but US investment grade bond is higher. And US high yield bond is less than the US investment grade, but higher than the US 10-year Treasury. But look at this emerging market debt in USD, in fixed income, it is the highest one. Because if there is an interest rate hike, then the money will come back to the developed market economies again. Because there's a really good return in developed market as well, if there's an interest rate hike. And now, if there is a rate cut, this is also important. If there is a rate cut in the economies, as we will see as of 2024, because European Central Bank, Federal Reserve, Bank of England, Bank of Canada, all started to their interest rate decreasing process. So we are here. We are in this picture. So what will happen to equities, fixed income, and other investment strategies and allocation? If, as we see today, if there is an interest rate cut in the developed market economies, what can be happen? Then we will easily understand the strategy here. As you see the equities in, let's say, the developed market growth portfolio, and here there is definition for these dots. This dark green is recession in 1989, and with a soft landing, there is a monetary policy mix in 1995. This black blue. The light blue is 2001 recession, .com, technology .com crisis. And the purple one is showing the recession in global financial crisis. And the light green is COVID-19 crisis. 2024, 2023 is the orange one is post-pandemic rate hike cycle. After the inflation started to increase, the developed market economy started a rate hike cycle in 2023. And this is the fear of that cycle. And the range for the 12th month, the gray line shows the range. As you see here, for instance, in global financial crisis, after the interest rate decrease, as you see, almost all equities going down. Almost all equities going down. And here, as you see, let's say in, how can we say, this is 2007 crisis. For instance, in, let's say, global fear, that's one, the COVID pandemic style. After the interest rate cut, almost all equities in the world gaining growth and earning per share. So what can we understand from this picture? These pictures directly or indirectly trying to tell us that if there is an interest rate cut, the dynamics does not working always in the same style in the developed or emerging market economies. Because in 2007 crisis, after the rate cut, almost all economies stock exchange crashing, but after the COVID-19 crisis, almost gaining strength and performance. So today, as the global financial crisis shows us that, the picture will be like this, not like this, because we almost finished the global financial crisis and COVID-19 crisis today. And the central banks are really good and efficient while they are dealing with and fighting with the inflation in the rest of the world. And here, if you look at the fixed income, for the fixed income after the rate cut, almost all economies getting strength. This is normal because I made this explanation a fifth slides or a fifth class ago. It's about this. The price of the bond and the interest rate has a negative correlation. What does this mean? If the interest rate is decreasing, the bond price is increasing. So if we have a rate cut, meaning that interest rate decreasing, we will face an increase in the bond prices. So fixed income will have a really good performance after the rate cut cycle. And now, please try to look at this picture. This is really good brief explanation of what is happening in these economies and what is happening in alternative sources of income. If we have this style of understanding what can be happening in these economies, alternative source of income, and what can be what can be understood if we have equity, fixed income, and alternatives. Equity is orange one, the fixed income is the black one, the alternatives is blue one. As you see here, we have other types of explanation as well. These are showing to us directly. Please look Asian high yield bonds. This is Asian high yield bonds earnings. This is approximately 11% as a sources of income. And global transport, this is an alternative investment, and this is approximately 9.5 almost. This is almost highest. But if we have here, please look at US equity, almost 1.3%. What does this mean? If you have a possibility to put your money in Asian high yield bonds, you will get approximately 11 or 10%, but in US equity, you will almost get 1.3% earning. This is approximately 10% spread between those income and earnings. It is crashing for lots of economies because 10% is almost for any type of investor. It can be a hedge fund, it can be a mixed portfolio. 10% spread between the earning and net performance at the end of the year is really huge. So, as you see here, if I have a 1.3% in US equity, or if I have a possibility to get approximately 11% in Asia high yield bonds, I will make a really good asset allocation to benefit from this spread. It is almost huge money in the financial market in any type of perception. Then let me try to explain here what can be the difference in equity and, let's say, the fixed income side. As you see here, if I take a look at the orange one, the equity one, the emerging market equities and Asia Pacific, excluding the Japan economy, they almost have approximately 5% return at the end of the year, meaning that the equity return is almost 5%. But in the Europe or developed market economies, the equity return is really low. So from this picture, I can easily understand that if I have a possibility to take a position in the equity side, it will be absolutely in emerging market or developing market. It will not be in the developed market economies. And now, please let me explain this concept as well. Understanding the alternatives. So I decided to take a position in stock exchange, fixed income, bond, or cash. So what can be the alternatives for me to take a position in this different type of style and different type of investment and asset? So let me explain this in this left-hand side. Alternative portfolio and fixed income. What does this mean? Here I have alternatives and risk portfolio and return. These are annualized return as of approximately 30 years ago, 1990s, and today. And here on the left-hand side, y-axis, I have the annualized return, and here I have annualized volatility. Please look at this picture. What these pictures try to tell us about the volatility and annualized return. These pictures tell us that if our volatility, meaning our risk, if our risk around 13%, And if I make an asset allocation with the weightings of 70% of 70% of stocks and 30% of bonds, then I will have approximately 10% return with this asset allocation. But please look at this one. What does this picture say us about those? This picture is saying us that if the stock weighting is 40% now, meaning that I decrease my risk. Stock is risky, bond is less risky. Now, if I decrease that, then my annualized volatility, my risk will decrease to 7% from the 13%. Please look at here. This is 13% risk. And now my risk is 7%, but my return is approximately 7.5% as well. So from this picture, everybody can here understand that how much the asset and allocation is risky, your return will be higher than the averages. So if you have less risk, your return will be the lowest. If you have highest risk, your return will be the highest. So risk and return has a positive correlation. You can understand from this picture, this basic information easily. And here at the right-hand side, I have public and the private market and public market correlation. And here I have different correlation and fixed income, or let's say equity, risky asset, riskless asset. I have different sorts of investment strategies. Here I have global bonds, global equities, US core return, Asia Pacific core, global core infrastructure, direct lending. Here private equity, equity long and short-term investment. Here relative value and macro and Bitcoin. These are the cryptocurrency. And please look at here the titles: financial asset, global real estate, other real asset, private market, and I have another things here: hedge funds and crypto. What does this mean? If I have an opportunity that hedge funds, please look at this title: global bonds, global equities, US core, APAC again. This is a correlation matrix, okay? And here, as you see, the highest correlation I have, positive or negative, it is not important, because here, as you see, 0.9 mean almost same correlation, because correlation change between 1 and a minus 1. So 1 is perfectly positively correlated, and minus 1 is perfectly negatively correlated. So if I have a 0.9 here, what does this mean? This means that, by the way, this is negative. Equity long, short, and global equities has a direct negative correlation. But sorry for this. This is red, but the minus is here. So red does not mean minus here. Please look at, let's say, negative correlation here: US core and global bonds. So if I have a position, global bonds and US core return, it has a negative correlation, meaning that if I have a position in global bonds and if US core equities getting strength, I will lose money because they have a negative correlation. You can understand this basic picture in this style. I want to reflect exactly this picture because I want to show what can be happen in your long-term asset classes if you are patient in financial market. Please look at this one. You have only $100 and you are in 1993, approximately 30 years ago. If you put your $100 and if you put your money now, US equity, US high yield, US aggregate, and US short-term treasury, what will happen to your money, your $100? If you put your $100 in US equity, it will be $1,000 in 30 years, meaning that 10 times higher. If you put your money in US short-term treasuries, you will lose your money. This is tragic. You are waiting 30 years and you are losing money. So waiting in financial market does not mean always a positive return. Sometimes even wait until the end of the year or until forever, you can lose the money again. So if we are wait in a concept, in a sector, or in a financial market, we will also be selective in that strategy, because in US short-term treasury, you are waiting 30 years with $100, but you are losing money. But in US equity, your income is 10 times higher. But let's change the picture. If it is, let's say, US aggregate bonds, it is 2 times higher. Or if it is US high yield bonds, if it is 4 times higher. So please be selective and patient. And now the compounding effect. What does this mean? If I wait in the financial market, what will happen to my money? If I wait in the financial market, what can be happening my money if I wait in correct sector and patient? So MSCI World Index performance, as you see here, if I put the index approximately in 1970s 100, it is now 16,000. Please try to understand this. If it is 10 times higher, it is 1,000, but it is now 16,000, meaning that 160 times higher earning as of that time. Meaning that if you put $1 million, it will be approximately $163 million. $163 million. Huge money, huge growth. This is the compounding effect of that patience in the financial market. And this is S&P 500 cumulative strength. And this is total return if remained invested since 19. Please look at $100,000. It is $5 million. Total return if you miss some days. Implied compounding, please look at this one. And actual loss from missing days. Please look at this huge picture. You have just 100,000 and the money here is $1 million. So the compounding effect, if you choose the correct sector and if you are sufficiently patient, you will get a huge money at the end of this patience. And now, at the end of the slides, I will reflect the portfolio construction and asset class return and volatility. Here again, high dividend yields. Here, the orange one is equities. Bond and cash is blue one. Alternative investment is green, and purple is portfolio. Your balanced portfolio, conservative portfolio, and aggressive portfolio. Aggressive portfolio is higher volatility, higher return. Balanced portfolio, stock and bond is almost same weight. And the conservative portfolio, meaning that I have higher bond, but less stock and equities. And as you see here, if you are aggressive, and if you are in, let's say, high yield bonds, your volatility is around 15%, but your return is 8%. But if you are conservative, your volatility is just 6%, but your return is just 4%.